conversation with Mr. Vaidyanathan, MD and CEO of IDFC FIRST Bank. They announced their quarterly results recently. It was a good quarter, but we're not here to talk just about the quarterly results. We're catching up with Mr. Vaidyanathan on where the bank is 3 years after the merger and where it heads from here. So lovely to have you here. It's been a while. Let me start, Mr. Vaidyanathan. Mr. Vaidyanathan, you can hear me?
Just a little louder will help.
Okay, great. If you can hear me now, I just wanted to sort of start by asking you not just about the quarterly results, but sort of look at the journey so far in 3 years after the merger and where we go from here. A good starting point for that is something that investors have been eagerly looking out for, which is the final collapse of the structure, the merger of the IDFC holding company with the bank. It looks like that is now moving forward from both sides.
Yeah, I mean, you've seen that in public domain at this point of time that the two institutions have expressed a broad interest. But really, there is a lot of ground to cover between the intent to actually make it happen.
There are the structure at the holding company side has to be simplified essentially.
Well, like I said, there are things to be sorted out, maybe at their end, maybe at the organization. So let me just leave it by saying that the intent has been established, and I think there's some way to go.
Okay, I'll press you to try and see how quickly this will get done. Is it a first half FY23 story, perhaps, or is it going to take much of the financial year?
No, we're not giving any timelines at this point of time because there are just, we got to, like I said, sort out certain uncertainties. We'll talk about that when we get a little more clarity with regard to the movements at both ends.
Okay. Sir, in many ways, IDFC FIRST Bank is two banks in one. Although it has been 3 years since the merger, but there is still a legacy part and there is a future part that's being built out. I want to talk a little bit about some of the legacy issues. Now, there have been asset quality issues on a number of those accounts. Can you give us a little bit of clarity on where you are and how much more, if any, pain you anticipate from those IDFC and IDFC Bank legacy accounts?
Well, we said this in the last maybe 10 odd days that really all the legacy issues are behind us. I think you're asking this question because in the last 3 years or so, we had quite a few accounts that we dealt with. I'm happy to say that almost most of these issues are behind us. Maybe there might be on one account or two, but even that account is not going to really change the scales of the P&L of the bank in any significant manner.
When you say behind us, you mean that most of what was stressed has been marked as NPA and provisioned? Is that what you're saying?
That's right. You see, at the time of merger, our list of stressed accounts, so to say, was close to about 4,200 odd crores. I'm happy to say that that number we worked on those accounts from time to time. Some of them got solved and some of them became declared as NPA. So they're already there in the numbers. Today we see our NPA, they're already disclosed. So that number of 4,000 has come down to just 1,000 crores or so now. And within that also, there's a provision percentage as high as about 80%. So we don't see any more significant hits to come to the P&L. And even if there's an odd account that might come, it might increase the gross NPA, but still it may not be a significant profit and loss account hit anymore. So I think this word LEGACY, I think this entire spelling we have to forget. And now we have to focus, a bit ahead.
In a bit, sir. I am curious, just perhaps out of academic interest may not make a difference to the company's financials going forward. But did the stress play out as you had anticipated 3 years ago? And give me a ballpark. What part of that book, the IDFC Bank book, ended up turning stressed?
Well, it's like going back in time and talking about these things here. You covered us at the time of the merger.
I want to know what the final position was, what it ended up being.
Yeah, it ended up being meaning that we took, since you're insisting so much, precisely, let me say, close to about 2,000 crores of loss we have taken to the profit and loss account from the so-called legacy book that included all the well-known big names. Fortunately, the telecom account came back and there was no hit on that account. But if you insist, the number is about 2,000 crores. And apart from that, there was a certain amount of loans that were sold, close to about 6,000 crores was sold to ARC even prior to the merger. The drag on the P&L hit came. But I think, like I said, all that is factored. The way we think about it is that it's part and parcel of the merger. We shouldn't really blame because end of the day, infrastructure is not an area that went bad only for our bank. I think the whole Indian system suffered from infrastructure loans.
Sure, and I certainly won't go into that discussion because that's a 10-year-old discussion. But one of the concerns, Mr. Vaidyanathan, I think from an investor standpoint, has been the ROE side, the return on equity. You've given some guidance, but I think there are questions about how quickly you can meet that and how
now we are coming to the absolutely the right questions.
So, yeah, I would have liked to understand what happened versus what you had expected when the merger happened. So I'm not sure that was the wrong question.
No.
On the ROE side, so one legacy which does still come into play, which is the liability side. That can you give us some sense of when that winds down?
No, I'm coming to that. So I meant more a lighter way, so don't take me. So the thing is that, well, as far as our bank is concerned, where does ROE come from? Return on equity comes from operating profit. And I'm very, I'm quite happy and very confident that what was the operating profit of the bank at the time of merger, pre-merger is about maybe about 90 crores in 2 quarters, prior to the merger. At merger, it touched about 279 crores. Now, operating profit has touched about 650 crores a quarter. By the way, you annualize it and you see what the numbers are looking like. Therefore, the return on equity flows through from that after providing for provisions. Now, I'm happy to say that the provision expectation for the bank for 22-23 is going to be much lesser than what we incurred in, say, 21-22. And when provisions come down and operating profit goes up, we expect to post, pretty strong profits into 22-23. And that will line up the return on equity.
Okay. To the extent that those legacy liabilities are weighing on the return on equity, that is winding down in about 2.5 years, according to your presentation, or will it happen sooner?
Well, again, that plays into return on equity. Now, you asked in the earlier question, how will return on equity come through? Let me just say there are 3 drivers. One is that the net interest margins of the bank are pretty strong. It's like close to 5.9%. Number 2, there is a 28,000 crores of, legacy liabilities. On that, we are paying 8.7%. We plan to bring it down to about, say, 4.8% or 5%, maybe 4.8. So, 8.8 minus 4.8 is a 4% or so difference at 28,000 crores. That's like close to about 1,000 crores of profit we are expecting just by closing, retiring the legacy liabilities.
That happens organically, or you can sort of speed up that process?
Very organically, because we're raising a lot of deposits in the bank, and we simply have to raise deposits in public and pay them off as soon as they're due. We're actually waiting for them to become due because it adds.
2.5 years, sir? 2.5 years is the best estimate right now?
2.5 years is the best estimate at this point of time, but the terminal maturity could be longer, but we could start paying now itself. So, short point is that 1,000 crores just by closing high-cost legacy liabilities to add to the P&L of the bank. That's a straight P&L. Number 2 is that you asked about operating profits. We also set up a lot of branches and ATMs and all that stuff. Liability side, that is costing us about 325 to 350 crores a quarter. That also will go away in due course when the bank scales up. The third is credit cards that is currently losing us money. So these are all part of setting up of any new bank. We shouldn't grudge these because that's at the cost of raising liabilities. When these 3 goes away, I'm pretty confident that if you add back these numbers even today, the return on equity of the bank will probably be close to 14% even today, just by knocking it off. So we think that this bank is headed in the longer run for anywhere between 16 to 17% return on equity pretty comfortably.
Just follow-up question on the second 2 aspects, sort of the infrastructure. So you are saying that at some stage you would anticipate a slowdown in incremental branch and ATM expansion. I get that what you have set up in the first 3 years will, slowly start getting amortized. But you're still a small bank. You still probably want to grow at some. Or are you saying that pace of growth in infrastructure will slow?
No, that pace of growth on branches will not be needed for the bank anymore. Not at that pace. Surely not. In fact, it doubled. In fact, I'd say that it moved from 200 branches to 600 branches in 2 years. So you can imagine tripled the branch network, and the ATM network went up 6 times or so. And definitely, we don't need that kind of pace of infrastructure anymore. So let me say the infrastructure growth will kind of taper off. and therefore we expect that profitability, these will amortize much faster.
How large will you go in terms of branch network, medium term, 3 to 5 years, whatever numbers you have internally that you can share?
Yeah, we initially gave a guidance of close to about 800 branches, and we're already at 600. So you can see that, even if I had 200 more, it's not like a big growth actually from now on. So the way we think about it is that loss that we're incurring because of setting up the branches on a quarterly basis, 300 odd crores per quarter, that number should keep shrinking now from now on, such that, it always happens for a startup bank. Vis-a-vis an established bank, it's there for 25 years or 30 years. They incurred the same cost maybe 25 years ago. So we are setting it up now. So, but the way the business model is that the income will begin to grow, and credit loss will come down. So, how the game plays after that.
And the credit card piece, you're putting a lot of weight behind it. It's a piece I know you understand from your earlier sort of part of your career, but it's also changed. It's also now, at least in the urban areas, metro areas, a crowded market. One of the largest players in this market is sort of seeing lower returns from credit cards, maybe a temporary phenomenon, I'm not sure. There are competing products, BNPLs in the market. You're still convinced that credit cards has to be a big play for you?
No, credit cards will be a big play in this country. There are only 50, 60 million credit cards, and there are 800 million debit cards. It can't be surely can't be that 800 million people can have a debit card, but they can't deserve a credit. So there's like an unlimited market out there. We are very happy about it because we've added close to 500,000 credit cards in the last 1 year. And the amazing thing about a bank is that we did not have to deploy any direct marketing associates, any DSAs, nobody. These are all customers. We could put out like 500,000 cards. I think it's quite fantastic. The reason it happened was we put out a customer product that was like fantastic. It's really very good. And by the way, if you're not having a card, please have one. It's just very good. So because it's got lower interest rates, it's got no annual fee, no joining fee. ATM withdrawal is except for a fee is free of interest. Like all things good. So basically, we think the product is a very good product, and we think this business will grow. I mean, we shouldn't be surprised if we put up say 2 or 3 million credit cards over the next few years, and we'll be one of the significant players in this industry.
Has sort of the risk perception on this product changed? I mean, there was a time when banks, after the blowout in credit cards post-global financial crisis, had said that we will only do it to our customers, the people we know. Is that the strategy you're following even now, or you are going beyond the bank's customers?
No, right now we are very heavily focused on our own customers, and frankly, our credit is being fantastic because really these are tested customers either on the savings side or on the credit side. But yeah, we're also doing open to market. And we're doing both, but largely existing customers at this point of time. But like I said, if 500,000 cards have to go to maybe 2-3 million credit cards, over a period of time, we'll open it up as well.
Okay. Sort of in terms of, again, the credit card side only, so this is going to be one of a very sort of part of your retail strategy in a big way, is what you're saying. There was a portfolio up there for grabs. You seem to have exited that race from what reports suggest.
I didn't get the question very well.
I said there was a credit card portfolio up for grabs, which could have allowed you to leapfrog to become a more significant player in the market, but it looks like you exited that race.
No. We're not in that. We're not looking at that portfolio. We just feel that organically it's a really big story coming up here. Like I said, no intermediary. These are direct-to-consumer cards. I think we are happy with this model. But actually, it's not only credit cards. When you look ahead into the bank's future, you talk so much about legacy. I told you, please forget that word. Because when I look ahead, our wealth management business is growing fantastic. Year on year, that business is compounding at upward of 50-60% per annum. Our fleet card business, we have put out close to 6 million of those cards, and that's coming really, very nicely. Our credit card business, I told you, 500,000 cards going pretty well. We got the home loan business is going upward of 44% a year. That's coming really, very nicely. Rural business is really big opportunity. The way digitization and technology is moving to the territory in terms of mobile penetration and all that. Rural business, we just feel it's just very large, and we're happy with that. So really, there are 6 or 7 big levers that are firing in the bank. And I think, therefore, our bank should be able to, forget our past, this legacy and all that. We should be able to grow pretty well, maybe 18 to 20% from here on, at least next year.
Mostly on retail, or all on retail?
Yeah, I mean, largely powered by retail, though we're also beginning to grow wholesale from here.
Yeah, so that was going to be my question at a big picture level, right? I mean, when you all merged the bank, I remember you sat down and you said you're going to have the highest proportion of, sort of retail in the overall book. Since then, pretty much everybody wants that kind of a model, right? Every private bank wants retail. Cooperative was a bad word for a long time. All in, all retail. How sustainable is that as a strategy, and especially if the economy starts to turn towards an investment cycle?
Well, absolutely. But I think we have some really unique capabilities on the retail side. Ira, I must point out to you that for 10 years, it's not a quarter or 2 quarters a year. For 10 years, if a bank can maintain or an entity can maintain a gross NP of 2% and net NP of 1%, through demonetization, through GST implementation, through economic slowdown, you name it. I think our capabilities are very unique. It's, retail is not like giving home loans and car loans alone. Retail is about being able to finance small businesses, being able to finance consumers by using advanced algorithms. We have developed some fantastic intellectual property. Our collection technologies have very much evolved. So we are a very, very digital bank. So I think these are very unique capabilities, and therefore we are feeling pretty good about this. It's not just, of course, India is doing well in retail for everybody, but I think we do believe we have some very good capabilities.
You had to restructure a fair amount during the COVID crisis, right? I think your restructured book is still towards the upper side if you compare it across the large private banks.
Not very much. We're at about 2.6%. And our book is behaving reasonably well. As you could see, the provision numbers for the last quarter came in pretty low, just 380 odd crores. And we had predicted a certain slope towards that. So therefore, restructuring all factored into the provision numbers we're guiding for next year.
So, you were talking about some of the innovative stuff on the retail side that you think got you ahead and will keep you ahead. Some of that happened while you were at Capital First. In many ways, the NBFCs is perhaps, an additional point of competition. It's not just the banks which are going all in, all retail. It was the NBFCs which would have been nimble and will continue to be nimble. Do you see a fair amount of pressure? Do you see more and more competitive pressure in that? And what does that do to the business?
I actually think that this is all set to grow, not just in our case, because we have a bit of a background in the sense that we had that capabilities that came in from one side. But even if you see the bank since then have evolved more and more into a more bank model, because we started giving home loans, we're giving prime loan against property, we're giving prime two-wheeler loans, we're giving prime business loans, and so on and so forth. Prime meaning we give the prime customers. But more importantly, when you see the ecosystem as such, I really wish there are more NBFCs. I really wish there are more banks. This is a very big space. I wish there are more technology firms. I wish there are more fintech companies, because when you step out and see the people on the roads, you just find hardly anybody has credit, despite all the credit that we seem to have.
True, but then that relies or is based on the fact that new to credit customers will perform as well as customers that banks have had in their books for a while. What's your experience been on this new to credit book?
I first of all, you should note that for most of our history prior to the merger, we were doing new to credit in a substantial way. Like close to about 25 to 30% of the book was new to credit. And that had a gross NPA, the book had a gross NPA of 2% and net NPA of 1%. So, this new to credit is not should be put together as one bracket. It is, it is the way banks or companies have learned to do, evaluation of the credit by using very advanced technologies. And we should be seen in that light. Though incrementally, as you might have seen, Ira, the ability to evaluate credit by multiple sources of data and all that, it's all very true. It's not just academic.
Okay, got that. Talk to me a little bit about some of this, whether you call it competition or collaboration. Probably the truth is somewhere in the middle between banks and fintech companies, payment companies. What do you see them contributing to your business if you are going through them?
Well, we work with many of them across the many of them work along with the chain of the process. For example, if you're processing a home loan or a car loan or any loan, there is somebody is helping you evaluate the bank statement and give you a quick analysis of the data. Someone is able to help you do a video recording. Someone is help you doing a latitude longitude evaluation of the customer. So there are a lot of fintechs helping the process. There are fintechs who are helping you get customers.
Yes,
so we work with all sorts of fintech, and frankly we think they add a lot to the either to the journey or in the ability to get customers.
That last piece is what I was talking about, the ones that help you get the customers. How important is that to a bank like yours to grow your business? And then on the flip side, how risky is it?
From our point of view, we work with all of them, like I said. Now, there are two types. One is the lending side. One is the lending side, people, NBFCs or fintechs who get us customers. Frankly, that is very welcome, and we do it because India is so credit starved. The issue sometimes comes on the liability side, because when many of these fintechs they get the customers in, then there is always some complexity about who the customer really belongs to. And if the customer has a problem, should the customer come to the bank? Should the customer come to the fintech for a resolution? So those kind of complexities more evolve on the liability side. On the lending side, it's like I said, India is so much underserved.
So, I mean, there was obviously some element of sort of concern on risk, because I believe these first loss default guarantee kind of structures were coming in if you were routing loans via some of these payment companies in particular. Were you using that kind of structure to sort of split the risk?
No, definitely. I think to an extent, these entities originate the loans. There are two types of possibilities that's possible. One is that you book the loan on our books on your own credit understanding, credit criteria, etc. In which case the risk becomes completely belongs to the bank, which is probably most of the book. But to an extent, some partners, some e-commerce companies also provide first loss default guarantee. So in which case the general requirement would be to actually for us to evaluate that entity and feel comfortable with the counterparty risk on that entity itself.
I think the RBI is frowned on that structure. So are there other options to then meet the same objective without using these kind of structures?
No, basically I think RBI wants entities to be able to be conscious of the counterparty risk. So and therefore which we should be, because after all, if you're taking FLDG from somebody, that party should be deserving of that risk being taken of that entity, and they're right for pointing this out. The other thing is about when you deal with these entities is about where it's a liability side. When they bring you bank accounts, then oftentimes there's an issue about, really, like I said, the kind of issues I talked about.
Okay, a couple of last few questions. So apart from sort of pure play retail, how is the SME side shaping up for you? And just to repeat the earlier question that I asked, if the economy cycle turns towards a more investment driven growth cycle, how willing are you to sort of jump in there?
No, the small entrepreneurs, see, in the SME side, there are two categories. One is the small entrepreneurs who want to borrow maybe 20 lakh, 50 lakh, a crore, 2 crores from you, and other entrepreneurs want to borrow a little more than that, maybe 20, 30 crores. Now, the SME or MSME segment, frankly, is doing really well, at least for our bank. It's been the area of strength for the bank since really such a long time. There, frankly, we see a continuous growth of 18-20% year on year for many years. That's like a large market. And credit performance, the funny thing, if you go to Credit Bureau and see the records and see the track record for the last maybe 15-20 years, you'll find that the smallest entrepreneurs have the least NPA. The larger ticket size customers have a little more NPA. The larger customers and the large corporates were supposed to be, they had the NPA of 16 to 17%. So now, of course, they're all being cleaned up once in a while for the system. So the small entrepreneurs actually have behaved well in the country, and I don't think I think we'll be very happy participants to that system.
Okay, so last question then, Mr. Vaidyanathan. So as you see the growth ahead, and I'll keep the visibility to say the next 2 years or maybe 3 years. You're done 3 with the merger. What's your focus? What are you putting your weight behind?
See, I think if you take a good assessment, I think few things have been achieved really very well. I think our big one, which many of you, including you, had challenged me quite a lot at that time of the merger, was that, look, how do we manage liabilities? I think the liabilities are sorted, and I think we're feeling very good about it. Number two is asset quality. I think asset quality is also solved now. Whatever is there, just closed. Otherwise, no major issues yet to come. That leaves only profitability. You solve one thing at a time. I think we solved two things. I think the third item to solve is the profitability. And I think from next year onwards, that is 22-23 onwards, you should begin to see pretty solid profits at this bank. And I think you should begin to expect that from us because the core NIM of 5.9% has been established, and that should translate to the bottom line from next year onwards. I think, therefore, that in all, I feel that at least I think the next 22-23, 23-24, and 24-25, the 3 years block coming up, you can wait and watch, but I'm feeling will be really good years for this bank.
All right, Mr. Vaidyanathan, I'll leave it at that. Thank you for taking the time to speak to us, past and future. Appreciate you speaking to us here on BloombergQuint.
Thank you, Ira. Nice speaking to you.
Thanks for watching BloombergQuint.